Trevelyan Next is a division of Trevelyan, a financial services specialist search and talent advisory firm. Since inception, the Trevelyan team has dedicated itself to enhancing the return on investment of a company's most important resource, its people.
Hello, everyone. I am Indra Ilangavan, Head of Strategic Advisory at Trevelyan. Commercial real estate has made significant headlines, and to understand the implications for banks, we have Cushman and Wakefield sharing their insights with our two bank CEOs. The bank CEOs will ask questions to Cushman and Wakefield, the top of their mind questions on CRE. First, I would like each of our panelists today to take a minute to introduce themselves. Let's start with Michael.
Hi, my name is Michael Denise. I'm head of the private capital group at Cushman Wakefield Mid-Atlantic, where I've been for 7 years, and I have over 15 years have been in the commercial real estate sector.
Thanks, Michael. Jack?
Hi, I'm Jack Hopkins, President and CEO of CorTrust Bank. We're a $1.6 billion community bank located in eastern South Dakota and in the Minnesota market, primarily in the metro Twin City area of Minneapolis-St. Paul.
Thanks, Jack. Mark?
Hi, I'm Mark Hesser, President and CEO of Pinnacle Bancorp in Omaha, Nebraska. We're a multi-bank holding company for 4 community banks that operate in 8 states in the Midwest, and we're about $18.7 billion in assets.
Thanks, Mark, and welcome, everyone. So let's get started. Michael, lay out the trends and bring us up to date on what you're seeing on CRE by asset types and regions.
Absolutely. So first of all, I would just like to start off by saying that I realize there's going to be a lot of questions about this. And so what we're going to start off is we're just going to go through everything and what we're seeing on the national market, cover each of those different asset classes first, and then bring it back for questions afterwards, since this is definitely an unprecedented time, at least in my lifetime, and at least in this most recent real estate cycle, to be seeing a lot of these numbers. And I know a lot of people are going to have a lot of questions. So starting off with office, which is on everybody's mind. Office sector has been, has had a difficult year ever since interest rates started increasing in the beginning of 2022. It really kind of exacerbated the situation that was created by the work from home scenario that we've seen since COVID. Now, overall, that was a trend that had started many years before COVID, where more of the work population was, kind of commuting to work maybe only 4 days a week, or some jobs you started to see an increase where they were exclusively work from home. But it was a very slow trend that was kind of moving mainly based off a generation, and very rapidly COVID completely changed that, and that really disrupted a lot of the fundamentals of office throughout the nation, really regardless of what sector, what asset class it is, what market it is, whether it's urban or suburban market, and it really even regardless of what region it is. And so we're going to go over really national trends and then kind of dig back down a little bit to regional trends. But as you can see, vacancy overall for the past couple of years has been increasing. This kind of comes off of a trend that had started a little bit at the before COVID, but really just shot up over the past 3 years. And right now, you're on the national side, we're hovering at around 20%. And it's continued to going up, and we forecast that to continue to go up as there is still more office that's coming out that was under construction before we saw a lot of these interest rates rising. And companies are still really reimagining themselves. On a per square foot basis, we're still seeing a little bit of increase. It's slowing significantly. Rental growth has really kind of grinded down to 0.1, 0.2% increase on a monthly basis. But overall, we see this going down, and this number doesn't factor in what a lot of people don't look at, which is inflation. And the overall, while the asking rents have been going up over the past couple of years, this is not inflation adjusted, and most numbers are not tracked this way. We do have those numbers and we can provide those numbers. But overall, in general, the rent is starting to drop on a real-time basis when it comes to most of office. And again, going down to that rental growth, we are seeing, on a year-over-year basis, very, very mild growth. 0.7% is not what people were underwriting 3-4 years ago. People were looking for 1 to 2% at a minimum. And just nationally, that really has ground down. Again, on a real term basis, we're looking at negative rental growth. So not a lot of good indicators here, at least when it comes to the overall scene. We're gonna dig down a little bit more because there are some highlights in some markets, and there are some highlights in some asset classes. But as you can see, a lot of that is really driven by that work from home trend that has been continuing on. The unemployment rate, generally when it's this low, office is doing well. It did tick up, and these numbers are from just before August numbers that ticked up to 3.8%, I believe, for U.S. unemployment. But labor force participation still has much to be seen. It hasn't quite gotten up to the numbers that we saw, in February 2020. And that is also part of the factor. So it's not just that more people are working from home. You also see that there are fewer people in the labor force period. And so all of that is going to kind of combine to really put a damper on space occupancy and building occupancy. So these are the overall trends, and I wanted to put a visual on all of this so that people kind of understand what things were like leading up to the pandemic and what things have been since then. And as you can see, there are some negative signs, but there's also some positive signs. For example, the fact that space under construction has decreased significantly and has been under the 10-year average for the past 2 years is a really good sign. It means that if less space is being constructed, you don't have to worry about negative absorption as much because there is a whole bunch of product out there that is becoming obsolete. And as we'll talk later, a lot of the product that's becoming obsolete is either being demolished or turned into apartments or some other type of space. But as long as the construction is down, that's at least one good fundamental. It'll help recoup some of that vacancy in the long term, not necessarily short term, because we have to take a look at this from both the long term and the short term. But overall, as you can see, vacancy, it was flatline, ticking up slightly right before the pandemic, but since 2020, it really has increased significantly to even numbers that are higher than what we saw in 2007 and 2008 so far. Which is, has a lot of owners really worried. As somebody who's looking to see this as a cash flowing asset, high vacancy rate and a stalled asking rent, but on a real basis, a decreasing asking rent on a per square foot basis is really like the worst of all scenarios for you as an owner. So there definitely are some negative signs. We're not going to try to sugarcoat that completely, but there are multiple factors here. So overall, what this has resulted in, negative absorption for the past few years, which there is still a little bit of construction left, but this is where this sector right here is really where we need to figure out what to do with all this space as owners, as buyers, as us working as real estate professionals who advise owners on what to do. That's what we're focused on, and on the national level. So digging down into the regional level, and we put 4 different regions up here. And I wanted to have this as a basis so you understood what we mean when we say West versus Midwest, South, and Northeast, because everybody has a slightly different definition. we see similar tales, but not the same thing. So as you can tell, throughout the U.S., there's been, drastically increasing negative absorption quarter after quarter. Starting in, the beginning of 2022, you had, negative absorption in the 2 million square foot range, and now we're in the 25 million square foot range, and it's been increasing consistently over each quarter since then. So really a lot of space that is being underutilized, a lot of buildings that just have a ton of vacancy that needs to be filled. Northeast has been consistent throughout that phase. They really have, them and the Midwest and the South really have all followed the same course. But really, a lot of where we're seeing kind of a drastic measures on this is in the far west. So California, LA, San Francisco, San Jose, Seattle, Portland. Those markets are really where we're seeing a drastic increase compared to the other markets. That is really, cause for alarm for some that are assets are maybe focused in that area. Vacancy standpoint, each region has followed similar trends. Some are a little bit more exacerbated than others, such as Midwest, which has increased nearly 400 basis points in vacancies since the second quarter of 2022, which for a single year is really something we haven't seen before, except for maybe a couple of times throughout 2008, 2009, for a single year. And so, but overall, a lot of the different regions are doing poorly when it comes to vacancy, with, just continued increases. And we expect that this increase will likely continue for at least the next 2 quarters. But there are really 2 schools of thought when it comes to going forward in a lot of our predictions. And so it could either be, right, because nobody really knows the answers going long term, but we provide really 2 scenarios that are going to be most likely, which is either the office market is about at or about to hit the bottom when it comes to the worst of the market. And from there, it'll stagnate for a couple of quarters before starting to recover a lot of that rental growth, the vacancy, or and that's what we could call our baseline scenario when it comes when Cushman Wakefield forecasting, or there is kind of a slightly worse scenario, which we call the downside scenario, which is that we're getting close to the bottom, but as a market, we're not going to bottom out when it comes to rental growth and vacancy until we get closer to halfway through 2024. And those are really the 2 most likely scenarios. There are obviously there's more there's broader forecasting that we have that predicts worse or better scenarios, but that's our baseline and slight downside forecasting that we consider to be the most common. And so now that we're done with office, I think it would make sense to open it up to a couple of questions from our panel.
Yeah, Michael, I have a follow-up. As your numbers reflect the vacancy and some, you mentioned a little bit the impact of work from home, return to work, but if I'm correct, I think your vacancy numbers reflect leases that aren't paying any rent. I don't know if they take into account spaces that are paying but dark, or spaces where 50% of the office is vacant due to work from home, but they're still paying their rent. And I think when we went into COVID, there's about a 7-year average life for the office market lease out there. I mean, potentially you've got another 5 to 6, 10 to 12 years left of leases that come due and renegotiate as they come due, lessening their space. How do you see that work from home playing out in the coming future years as these leases come due?
That's a great question. So at the very beginning of the pandemic, we saw there are companies that track essentially what's called like key card access into buildings, and that's a better indication of what the actual physical occupancy is of those buildings versus just what space is being leased and occupied by the tenant. And it drops down to something like 20 to 25%, almost immediately in March and April of 2020. And it's been very, very slow to get back to normal. And right now, it really depends on the market. West Coast markets, as I pointed out earlier, are doing a little bit worse. And they're, if you take a look at San Francisco, you take a look at LA, Portland, Seattle, they're hovering in that 40 to 45% range of actual occupancy, of actual, employees coming back into the office compared to February 2020 numbers. Some of the best markets we're seeing, Austin, Houston, Miami, even those are topping out at around 60%. And they are anywhere in the 55 to 60% range in terms of actual occupancy. Numbers are very, very slow to return. There was kind of an initial movement in 2021. 2022 is where we kind of saw a little bit of a peak, and 2023 has been only slight improvement since 2022. So, and we're talking by slight meaning 2 to 3% increase. If it keeps at that rate, and that's worst case scenario. If it keeps at that race, you won't see occupancy get close back to 100% for decades. But we don't see that happening. We see that very rapidly because of some of the downturn for some of the larger companies, some of the tech companies. People, a lot of companies and groups are forcing workers to come back. We just heard that recently from Amazon, Goldman Sachs, and a lot of tech companies as well. That they're really pushing to have their workers come back in the office. Now that we're so far off, or so far removed from the beginning of the pandemic and from the first couple of waves of the disease and the lockdowns, I think you're really going to see 2024 as a time when employers are really going to push for that. And whether there's a slight recession or a heavy recession that's going to cause a lot more layoffs than we've already seen, that could just help with that, as workers will start to lose a little bit of their advantage in the negotiations for their place of work. And I think that already we've seen from a lot of employers, which is why you're seeing a lot of them push people back into the office, is they're not seeing the kind of productivity that they saw 3 or 4 years ago. And it's very evident. And so, long term, how does that happen? How does that work out? I don't, have a crystal ball for you, but I think there is definitely pushback for it. And I don't think the 40 in the worst markets, 60 in the best markets right now is where we're going to see settling. It might be closer to that 80 to 90% range, or maybe just, the 80 to 70% range long term. But it still leaves a huge gap. You're right.
All right, thank you.
So Michael, I was looking at the numbers you had. You said you show a negative 24 million square feet of net absorption. But yeah, we've got 71 million square feet under construction. What is under construction when the markets are kind of doom and gloom for a lot of the larger office projects? And then part two of that, is this more confined to smaller projects or owner occupied, or what are we seeing?
Yeah, great question. And I think that it really, we're looking at things from a national level, but really ultimately real estate is about an asset per asset look. And no asset is going to be exactly the same no matter what market it is. And that's really kind of speaks to those projects, which are primarily build to suit for larger, corporations that need a specific footprint. You're seeing, Class A within Class A markets has still retained a lot of its value compared to the lower Class B, Class C buildings. And that's where, you're going to see more of that construction, is if you have high demand in a very specific sub-market of a city or of a metropolitan area, that's where, 90 to 95% of all that construction is taking place. So again, if you have a build to suit where you have a tenant that, really needs this specific building built for them that doesn't exist yet, that's where you see that. So let's move on to retail. And this is one that at the very beginning of the pandemic was thought to be kind of a goner. The pandemic really kind of, retail was not doing well leading up to 2018, 2019. It appeared to be overbuilt, and it appeared that the e-commerce was going to come forward and kind of eat its lunch. But you know, overall, while you saw a little initial kind of disruption in the market, the fundamentals are significantly better than office. And the question is going forward is, how much did the pandemic push people to get more into experiential retail and want to get back to, interacting with other people again, where buying, merchandise online, you can't do that. I think that we're seeing a little bit of a kickback from that, and so there may be long term. I think there's still going to be some fluctuations related to that, but it's not a doom and gloom scenario. There's no doom loop that's kind of projected for national retail at this point. Um, but as you can see, the net absorption really sank in 2022, and it really recovered since then. Vacancy has been decreasing steadily but slowly, while the rental rates per square foot have been increasing. So standard fundamentals that you would see. It doesn't appear that the recession has really been affecting this asset class too much. But again, I think you still have to factor in. At first, everybody was afraid to go out, afraid to go to restaurants. They were afraid to go to malls. They were afraid to buy things in person, and everything went online drastically. But a lot of that online sales has started to slow down and kind of decrease a little bit over the past year to year and a half. And that has really kind of provided some decent fundamentals nationally for retail. You also had at the very end of 2019 a dramatic drop in construction, which really allowed a lot of the space to be absorbed. And all of that kind of led to retail had really placed itself in a perfect situation to be able to meet a lot of the problems that the pandemic was going to present to some of the other asset classes. But we track this on across different types of what we call malls, right? You have your power centers, your neighborhood and community centers, your strip centers, your major malls. Major malls are still not doing great, and they probably have the most exposure. There's a lot of vacancy there, but most owners have figured out a way to use those. And because regional malls tend to be very far and few in between, you have one per city or one per town. You're not talking about multiple assets that people are having to figure out a solution for to reuse. And so a lot of them have been turned into office. A lot of before the pandemic, a lot of them now since then have been turned into data centers, into industrial, and or have been changed into more modern forms of retail. Outdoor malls are very popular these days. So there's a lot of fundamentals that are keeping retail strong. The bump that really kind of pushed it down at the beginning of the pandemic, in terms of the increased vacancy, that decreased absorption, that is now doing strong. There could be a reversal to that, right? It's kind of like if you drop if you're creating waves, there's always going to be peaks and troughs, and it could be that we're in a peak right now based off of that, but so far there's nothing in the fundamentals that show any sort of disruption there. Recession obviously will have an effect on consumption from shoppers, and that would have an overall effect on the retail market. But at least going into that, retail is not currently overbuilt. Going back to the last slide, as construction continues to decrease, so there's really not a bubble of construction that we're seeing may interact with a decrease in shopping or a decreasing in consumption that would normally come with a recession. So overall, retail is doing fairly well right now.
I guess I'd have a question on that because I'm looking at a couple of different markets here. I've told you we're in South Dakota, and that would be more of your power regional in Sioux Falls, South Dakota, and that mall appears to be doing fine. But when I go up into the Twin City metro market, I'm seeing a lot of big box stores that are empty. And it looks to me like it's going to take a decade to fill some of those box stores. I mean, I've got malls that are almost ghost towns. So what are alternative uses that they're going to use for these properties in these major markets that I'm seeing?
So it really depends on the market, but kind of what I just said when it comes to the alternative uses, you know, there's self-storage, there's data center, there's industrial. Those are three markets that are very strong right now. And you know, it really, when it comes to individual assets, that's one of those things where we have to understand that individual asset and understand the local market that's going to affect that. So it could be that it's going to be adaptively reused for one of those, or it could just be that the specific demographics for that area are decreasing. You have a decrease in population, a decrease in median income, or a stagnation of median income. And it could just be that that specific location is a bad location for retail, which is what you're going to see, you know, with a lot of assets. And I would just encourage anybody who, if you're looking at a specific asset, you know, part of what our team does is we are partially the strategic advisory services team. So we help owners, understand what to do with their assets based off of all these factors. We put together long, extensive, highest and best use studies to determine these. Every asset is different. So speaking to that specific asset, I don't know, but there may be a lot of different options to figure out what it is the best and highest use for that product. And it may not be retail. It may not be an adaptive reuse to an outdoor mall. It may be, which I'm, guessing if it's Twin Cities, an outdoor mall probably doesn't, probably isn't as great in that market as it would be, let's say, a southern market, because 6 months out of the year people don't want to be outdoors. But it could be industrial. It really all depends on the fundamentals of that asset. If it has, if it's close to if it's close to an on-ramp, off-ramp for a major artery, freeway, then that's, that could have industrial potential. So I would say when it comes to individual assets, definitely contact me afterwards, look into those specific ones, but there are a lot of different options out there for product types that are currently in construction booms, like the ones I mentioned.
Mark and Jack, do you have any additional thoughts or questions?
Mark, you're mute.
I would just concur. That's kind of what we're seeing across our footprint. Retail is generally pretty strong, particularly the strip centers. We are seeing weakness in indoor malls and, as Jack mentioned, big boxes to some extent, but generally retail is good.
Jack?
No, I would agree that with what Mark had said, we're not seeing that, but obviously with some bankruptcies and Bed Bath Beyond, some of these other big boxes, Dick's Sporting Goods has pulled out of a couple of locations. There are some big boxes that are sitting empty in a couple of malls that I'm seeing have high vacancy rates, and they're in what I would think are better areas of towns of the Twin Cities, whether it's in Edina or down into Eden Prairie. So.
Well, and part of the problem that we're seeing with a lot of those, and we're working with a couple of theaters that, obviously, Regal Cinemas recently declared bankruptcy as well. We're dealing with a couple of, big box, movie theaters that you can't really reuse for anything else. But what's nice about those is that they've been built with, 10 or 11 to 1 parking ratios. So there's a ton of parking there, and they're sometimes built in good places, but sometimes they're not. Sometimes they're built in the middle of industrial parks. Those ones, if they're in the middle of an industrial park, it's an easy conversion to industrial. But right now, what we're seeing from a lot of land developers and speculators is they can't get financing. And that may be a little bit of an issue when it comes to a lot of these big box vacancies, is that normally you might have a developer, a land speculator kind of gobble those up and figure out something new with them. But if they're not cash heavy, if they don't have a lot of dry powder sitting around, they're not going to be able to get financing just to hold this land. And so I think that's also another part of the problem, is trying to resell those assets. It can be a little bit tricky with the buyer's market. So then that leads us to multifamily. And this one, it went through a historic boom. Really 2010 to 2022 was probably one of the longest periods in time in which multifamily was doing extremely well. But as you can see, vacancies are starting to move up. We can, net absorption is increasing, which is good. And rents are increasing, which is good. But again, a lot of this is not factoring in inflation, which overall, for roughly the past year and a half, since the middle of 2021, since the end of 2021, on a real terms basis, multifamily rents have actually been decreasing. And a lot of people aren't speaking about that or talking about that, but that's a really very real thing to understand, because this is one of the primary factors in inflation. And so if you're not factoring that, if you're not factoring that in, as people's food and gas continues to increase, it may just look like, oh yeah, multifamily is continuing to do really, really well. But as we'll get into construction pricing later, all of this comes at a huge cost to the multifamily owners, because their expense ratios are really increasing with all of these properties as well. So the net income when it comes to that is really not helping out. But good side is construction is starting to decrease, and it has been decreasing over the past year. And people are continuing to be employed. So this is one of the fears going into the recession, is that you're going to have increased unemployment. But leading up to this, I would argue that an increased or decreased labor participation force actually weighs on multifamily more than unemployment, because you no longer have people that have given up or kind of living off of whatever funds that they have lying around. Now people are actually actively looking for jobs, so that might be a good sign that unemployment has increased slightly, but purely because from labor force participation is continuing to increase. But that's a big factor when it comes to the multifamily side, right? Do people have jobs? And then can people afford homes, which is the other big factor, which is right now, nobody can afford homes. So while pricing on multifamily is starting to come down a little bit, it is being suppressed a little bit, because you still continue to have more people staying in the rental market that normally, 2009 to 2021, or really the beginning of 2022, was really the cheapest time in American history to ever purchase a home. And a lot of the time, people don't realize that, because they saw pricing for homes continuously going up. But if you were to factor it in on a monthly mortgage rate, the average somebody was spending per month on their home was lower than in any other time in history, at least as far back as we have records. And that's something important to understand, and so that the new normal that is suppressing people from coming into the rental market, maybe that's going to be here for a little bit longer than we think, right? Maybe the multifamily market, where vacancy has been increasing for the past year and a half, asking rents have kind of been wobbling for the past year and a half on nominal basis, but then have actually been decreasing on a real basis for the past year and a half. Maybe that is going to continue a little bit, but maybe it's going to be suppressed from people staying in the rental market. And so you have a couple of different, competing factors there. One good factor, as I mentioned earlier, is the construction slowing down. Is it slowing down fast enough? I don't know, because there definitely was a bubble, from 2022 to the beginning of 23. We saw more space under construction than we had, really since 2007. And that's a big factor, because you're dramatically increasing the supply of space there. And so we'll see. I mean, going forward, again, not really sure how this is going to affect, how this is going to be affected by the recession. We have a couple of factors, but overall, this is fairly consistent for most of the markets. The South, in particular, you'll notice here is kind of experienced a little bit higher, right? They're already in the 9% range when it comes to vacancy overall. That primarily speaks to the construction. The Carolinas, Georgia, Florida, Texas has really seen, I guess Tennessee as well, has really seen a huge boom in construction over the past really for the past half decade at least. And that's really something that the market hasn't been able to catch up to yet. And if we're going into a recession, if we have a overall decreasing population from a naturalized standpoint, how is that going to affect us going forward? Well, right now it's really negatively affecting those vacancy rates. But the South, you'll also notice, and I don't think I have the slide up here, that their rents overall have been increasing much faster than other regions. And so even though you do have that increased vacancy, you do have the increased rents along with it, which does help kind of partner, kind of counteract some of those fundamentals. One big factor that we're seeing is really San Francisco, and it shows on this chart that San Francisco is really, really high compared to the national average. That's purely on a per square footage basis and what actual numbers. In terms of rent growth, San Francisco is seeing one of the biggest drops right now, and that's coupled with the office market. That is kind of an outlier. I don't like to talk about specific cities too much, but that's one that we've noticed is really kind of far out and ahead in terms of negative fundamentals from the multifamily and the office sector. That is kind of having a two-tiered storm right now. And whether that has to do with local policies, local laws, or whether that has to do with other factors, like they had a construction boom that they hadn't had before in office. There's a lot of different factors that can go into that, and that's a conversation we can specifically have with owners of assets in that market. But overall, it could be an indication that something similar would come down for other parts of the West that also had construction booms too. So.
It's a question for you. In some of these markets, are you seeing that rent controls are having pressure on some of these values of these properties? And I guess part two of that, I'm seeing cap rates still saying what I think are unreasonably low in apartments. Anywhere 5.25, 5.75 is what we're seeing on that. So obviously there's still a demand for that type of investment. So I'll let you answer those questions, I guess.
Two fantastic questions and really points too. So even before the pandemic, a lot of cities around the East Coast will tell you that they noticed a huge increase in the number of investors coming down from New York. Because in 2018, New York passed a whole set of laws regarding rent control that made it significantly more difficult for investors to be able to do work in that city. And that really did have real effects, right? We were talking about issues in the multifamily sector in New York City before the pandemic even happened. And that was almost entirely, although there were other factors too, that was heavily influenced by those rent control features. So, going back to San Francisco, that could be a reason. San Francisco's had rent control for a very long time, but San Jose, which also has rent control, has not had the same issues that San Francisco has, which is interesting to note, because those are two cities that are similar in size. San Jose is a little bit bigger than San Francisco. Similar market, right? They're both very driven by the tech sector. San Jose, though, has really, for the most part, recovered on the multifamily side, with a couple of exceptions since the beginning of the pandemic. San Francisco has not. It's really continuing to do worse. And so, I haven't done an extensive study into the difference between those two cities, but rent control can actually be a factor. And that's actually, not just in 2018, but that's why, really a multifamily building boom has been taking place over the Southeast, and to the greater extent, the South for a long time. It's just a lot easier to build things there. And in California and, Colorado is starting to go in that direction, but Washington and Oregon as well. If it's hard for you to build, you're not going to build there. And you're seeing that with a lot of groups. And so that's what's pushing up the rents in some of those places is really less of the demand and more of just the lack of supply. And so then the other question was related to, remind me again.
The cap rates. We're still seeing
Yes.
cap rates at 5.25 to 5 3/4 when we've gotten recent appraisals in on multifamily properties.
Yeah. So cap rates are taking a long time to kind of adjust. And I think part of the problem is that we don't really track cap rates very well. A lot of people are very secretive. Even if you go to the coast, we got some of our information from CoStar, but a lot of Cushman and Wakefield's research is going out directly to our brokers and getting that information. Most sources get it from these kind of these services like CoStar, like ERD Matrix, and they're not really reporting as many cap rates as we would like. A lot of what you see when it comes to the beginnings of the recession is a lot of people tend to hide the cap rates. And so what I've noticed with a lot of the deals that I've worked on the multifamily side is that the market has not really adjusted to it. And non-traditional lenders are understanding that and not factoring in lower cap rates. For example, I'm working on a multifamily deal right now where the appraisers came in and they appraised it at a 5.7 cap, and automatically the lender came back and said, well, we don't believe that. We're going to get a second, third opinion. Second opinion came back a little bit higher, but there is a real problem right now with the way that appraisers see cap rates and what cap rates really are. On the multifamily side, unless it's an absolute class A product, you're in the 8 to 9% cap rate, right? Or higher. If it's a class A product, if it's a class A location, there are exceptions to that, and it could be lower. It really could be. We're still seeing sales, for example, in San Jose, we're still seeing sales in the 4s for cap rate. And it kind of all depends on the market fundamentals, right? Different markets are driven, the cap rates in different markets are driven by different things. San Jose, for example, is driven by a lot of people that have a ton of money that are just looking for an investment to stick it in, betting on the appreciation of the asset growing their equity versus necessarily the cash flow of the asset growing their equity. In Florida, you have a huge influx of money, of international money coming from countries where inflation is significantly higher than we have here. Venezuela, a lot of investors coming from there saying, you know what, as long as I have an asset that's not losing value, I'm in the green. And so they're willing to pay 3-4% cap rates on Class A product, or even 5% cap rates on Class B product for multifamily. But a lot of it has to do with different fundamentals, and what you will see with a lot of those, obviously, is that they're going to be really, really heavy on the equity side. The debt service is going to be extremely low, and they may be using 60-70% equity to buy a property. So yeah, I agree with you. I think cap rates are overly inflated right now. I think a lot of that is just because we're not tracking it properly. And I think the market is still adjusting. But, over the next maybe 2 quarters, maybe 3 quarters, you'll continue to see the cap rates start to adjust to what they should be, representing, the income on the property and the interest rates. And we'll see what happens if the Fed raises interest rates again, then we're going to have to adjust this all down, or adjust the cap rates up, and we'll see. But yeah, completely agreed with you. There's usually a lag in a lot of these downturns when it comes to the different pieces of the puzzle talking to each other.
So if there are no follow-up questions on multifamily, we can move on to the next. property type.
Right. Great. And so then industrial, this is one of those sectors that has been booming for a while. It really took a huge hit during the Great Recession of 2008, 2009. But since then has really it's been completely energized. And to kind of speak to what we mentioned in retail earlier, it's really been energized, especially because of the boom in online sales. Now, does that continue on as online sales are starting to come back down or plateau a little bit as a percentage of all retail sales? Possibly, but the fundamentals are just so strong from a rental basis that it's really kind of hard to see. It's really hard to kind of see any negatives in this atmosphere. Now, granted, there's a lot of construction going on. It has slowed down a little bit, but overall, year over year, we just continue to see it all being absorbed. And so far, while vacancies have increased a little bit over the past couple of quarters, rents continue to increase along with that. So we really don't see that right now as a strong issue. For example, if the 95 corridor from DC to Philadelphia, and really to a greater extent all the way up to Boston, good luck trying to find, if you're a tenant, good luck trying to find space to lease. It's just so hard to find space. And with a lot of this industrial product, space can also be pretty specific to the user. So a lot of this space that is being created or constructed and put into the market is specific to those tenants. And so that's why, even though there might be a lot in the pipeline, it's already leased up. It's pre-leased, and so it's not going to affect. It's not going to negatively affect the absorption. Overall, you can just see the leasing activity it continued to climb. 2022 is a little bit less than 2021, but overall, we still feel like, based off of the current numbers, we're going to hit above 2019 figures and for this year. And while there might be a slight dip or a slight pause in the increase in rental rates on a real basis, we think they're going to continue to increase just based off of all the fundamentals. And you can kind of see this across board with most markets, right? There are a couple of markets, Providence, Rhode Island, and Florida, Naples, which may be outliers here, but most people are seeing very positive, solid growth across the market. And when it comes to these vacancy numbers, it's absolutely solid that they're all 3 or 4 and below. It's there's really nothing much bad nothing very bad about this market that you can say right now. If it's a deep recession, some of the earlier factors we've seen on is that some of the production has slowed down significantly, at least within the past month and a half. That could have some sort of a dent on it, but at most, if let's say we're going to go into a deep recession here, I would say at most there's going to be a slight correction in industrial, but nothing long term, nothing fundamental that's really going to decrease the long term value of this product. And as you can see, most investors say the same thing. I don't have the cap rates up here, but again, we're still looking at cap rates low 5s to high 5s, depending on how good the product is. But if it's a Class A fully leased new build product, you can still see in the 4s in terms of cap rates. So it's still, fundamentals are very strong for this, and it doesn't seem that there's any sort of decrease in demand from tenants.
Jack and Mark, do you have any follow-up questions or any thoughts to add?
I guess this might not so much on industrial, but just real estate, more questions in general in the real estate market. We're continuing to see the costs increase, of construction, but not just the basic construction costs. It's the property taxes. Of course, the interests have gone up, and then speak to insurance. And again, on with insurance, not just to new construction, but to existing properties, we're seeing insurers pull completely out of markets. We're seeing commercial insurance premiums go up 30 to 50% year over year in some cases. How is that impacting the construction market and the resale market?
Yeah, it's all continued to slow the market. We actually had somebody recently that was turned down for a loan on a multifamily property in Baltimore, where normally we wouldn't have any sort of issue. It was a decent neighborhood. Normally we wouldn't have any issues with this, but a lender just flat out told them that they weren't going to lend to that market. Now, granted, that's Baltimore, and not everybody's willing to lend into Baltimore, but even all the lenders that we were getting quotes from a lot of these properties, for all of our buyers, really, prices continues to increase. And as you can see in the National Construction Index here, which is what I wanted to go into next, so this is a great segue. You do continue to see an increase in construction prices across the board. 2021 was a huge year for that. We saw dramatic increases, 200, 300% for certain types of product. But at least when it comes to some of the main factors, lumber, iron, and steel, a lot of that pricing is starting to come down on the construction side. But that being said, everything else has still been going up a little bit. So while I would say overall construction pricing has come down slightly from its peak, you do have a lot of other factors in there, like insurance costs, that are affecting a lot of these deals and making some transactions. I mean, they're a piece of the puzzle that, from an underwriting standpoint, owners are looking at. I would say it doesn't heavily affect it. It might affect the deal, 10 basis points or so, or maybe 20 basis points at most. But on a cap rate, but for the most part, it's really kind of just putting a damper on the construction side and the redevelopment side than it is on value add opportunities that owners would normally be looking at. I would say that most of the damper on construction came really in 2021 and in 2022, and now it's people are starting to adjust to that pricing, so that it doesn't have as much effect on from what it did before.
I guess I'd follow up too then, whether it's related to construction or financing sales of existing property. What are you seeing from the money center banks, the really large regionals? Are they saying no to CRE loans in general? Are there specific categories they're saying no to, or are they saying yes to? A lot of times their appetite drives the market for everyone down the chain.
Yeah, definitely no to land and new build construction. There's been a huge decrease on that side from them. On the multifamily side, there's been a real cinching of the belt. And on the office side, again, we've definitely seen people being declined for loans on that side. I would say office and land are definitely the most significant affected by that. And then multifamily would be kind of like a not a distant third, but fairly not too close behind. Industrial, retail, not really heavily affected just yet. Retail a little bit. Industrial is fairly good. Hotel is also a huge problem right now, and getting a loan on hospitality is a huge problem for a lot of owners. But yeah, I would say those three, the hotel, office, and land, are where we're actually seeing a lot of lenders just not even going right now. So yeah, it's absolutely a problem for those industries.
Given the complexity of the landscape, it demands a differentiated approach and a conservative underwriting and a granular understanding of the portfolio and local market dynamics. So the diagnosis of issues are important, but the focus is really on the town. What are your thoughts, and what are some of the changes you have implemented on the talent side, on the credit team, across the board in terms of expertise? Maybe I'll start off with Jack.
Okay. Well, from our standpoint, we haven't had much of a change in our, what I call our talent pool. Obviously, we've had some replacements of people as we've reached retirement, et cetera, but we've kept our underwriting standards pretty similar for the last 20 years. So we haven't changed our underwriting standards. We go through the ups and downs, and we seem to survive those just fine. So I can't say that right now I'm suffering from a talent shortage. However, I've got some people reaching retirement age. You notice the color of my hair, and we've got a lot of people here that are in a similar situation, and we're working to bring that younger talent pool up and get them trained in, which goes back to my point, and I think maybe hopefully Mark would echo this, as we like the work in office, because how do you share your knowledge with the younger staff if they're not there side by side, seeing what you do on a day in, day out basis? So from our standpoint, it's grooming our people that we have internally right now and showing them what we have learned in the past. We've survived through the last 4 recessions without major issues, so we intend to continue to do that, just passing on that knowledge.
Great, thank you. Mark, would you like to add to that comments?
Yeah, I'll echo that. First, Jack's point. I mean, we obviously work in the office. I think I worked remotely for 1 week at the start of COVID, and then that was the end of that. So we're big believers in being in the office. We think it's required to get productivity. And as far as the talent pool, again, we haven't, like Jack, haven't made many changes here either. I mean, there is some talent out there floating around from institutions that have kind of said, well, we're not lending in the CRE market anymore. But I think what you'll find with most banks out there, well, there's kind of 3 areas of banks out there. There's the banks that have a fairly good portfolio of either ag production or C&I lending that have variable rate loans. They're fat and happy. Their margin's never been better in 10 years. They're content to do what they're doing. They're not looking to expand. And the banks that are into the CRE world are generally either running up against liquidity constraints because of their funding sources and their longer term bond portfolio they can't liquidate. So they're having to borrow their funds. It makes it harder to lend, or they've run up against the CRE 300% liquidity or 300% concentration requirement. So many of those banks already have a concentration in CRE. So they're not really looking to expand their talent pool right now either to grow into that market.
So are you able to capitalize on the opportunity to tap some of the top-notch talents from your larger counterparts?
We're kind of in that, we've got a great team. We're not trying to expand our CRE portfolio greatly right now. So we're kind of in that group of banks that's probably not interested in a big expansion right now.
Great, thank you. Michael, do you have anything to add from our side of things?
No, I mean, I think that if anybody who's watching this has any questions about the real estate market or what are different options for them as a bank, for different assets and plans for the future, I'd love for them to reach out to us. And if you could just provide our information when you release this, that'd be great.
Great. So this brings us to the end of the session. I want to thank Michael for your valuable insights, and thank you, Jack and Mark, for your participation and contributions in this webinar. Our audience would definitely, take away some valuable insights from this recording. Greatly appreciated, Jack, Mark, and Michael.